So again, at the end of last class, maybe not the end, but we talked about two rules. The 65-day rule, which gives you a certain degree of flexibility. In fact, this thing happens all the time. I was recently involved in a somewhat contentious change of trustee. The guy stepped down, and anyway, he didn't necessarily do anything wrong, but he was billing a lot, and the beneficiaries didn't like him. And he turned over the reins beginning of this month, maybe the end of May, but within the last couple of weeks. And the new trustee's attorney contacted me and said, we had a problem with the estimated taxes, but we think we got all the information. We filed the estimated taxes by June 15th. And my response was, well, you didn't necessarily need to do that, because maybe we can do what we've done in prior years, which is we distribute out enough to take out all the DNI, and then they loan it back. The beneficiaries loan it back, so that the trust has money to pay its debts, and yet we push the income out to lower bracket taxpayers. And in this case, maybe not even lower bracket, but if for whatever reason you can't make your estimated 1 year, then this is another way to solve that. So one of the things you do is, okay, you got that plan, but then how do you know when you're gonna get all the income out? Well, the answer is you can use the 65-day rule. So you can wait till the end of the fiscal year, see what the income is, see what you've distributed, and make sure that you've distributed maybe a little bit more than that, so that you can make the election. And then flush it all out for 2017, so the trust has no taxable income. Don't have to make any estimated tax payments if you've got no taxable income. Okay, so again, it's a very powerful tool in terms of doing things to reduce the overall tax burden. And I can tell you literally numbers of cases where people's, or either trusts or estates, are in the hundreds of millions of dollars, and it's one of the things that they use. We have one where the guy's worth anywhere from 500 million to $1 billion. A lot of real estate stuff. The wife lives in Arizona. The Arizona personal income tax rate is a little bit lower than the California income tax rate. So what do we do each year? Each year, she doesn't need the money, not surprisingly, as a surviving spouse, but we kick out as much as we can to her legitimately to have it taxed at lower brackets. We use the 65 days for that. So frequently, we're pushing right up against that deadline. Okay. Separate shares, again, where you have substantially separate independent shares, then they're treated like, if it's treated like substantially separate independent trust, but it's not a separate trust, then they're treated as separate shares. Okay, and again, these examples on the top of page 53 and the bottom of page 52 are helpful, but nobody's going to tell you these are separate shares. Some of you are going to have to figure out. But some of the examples on page 53 are helpful, and one of the best ones to remember, or two of the best ones, are one, whenever you have a residual gift, to my 3 kids in equal shares, those are separate shares. Meaning that you take the DNI, and each child or child's trust has 1/3 of the DNI. So if you make a large distribution to one child, then ultimately that will reduce the further and future distributions to that child, but it's not going to be taking out the DNI for the other children. Just also remember that if you have separate shares, you don't have separate trusts. So you've still got one tax bracket, one tax return, one tax bracket, one run up the brackets, and one exemption. So you may have 3 separate shares, but you don't get 3 runs up the brackets, you don't, whatever. So there may be reasons why we might rather have 3 trusts, although it sometimes takes time to establish those trusts. So if I say in my document, upon my death, establish separate trusts for each of my 3 kids, separate equal trusts, those will eventually be separate trusts, but until those trusts are actually funded, we simply have separate shares. Okay, separate shares now, at some point there's funding, separate trusts. At which point, when you have your separate trust, you've got the separate runs up the brackets. You've got the personal exemptions times 3. And you don't have to keep track of the DNI because each trust will have its own DNI. The other separate share to remember is that specific gift. Again, those are the two that you see most frequently. One of them is the residue, and then the other one is the specific gift. That specific gift, that income, only is going to go to the one beneficiary who's entitled to that specific gift. Of course, if you have a specific gift which says, I give this building to A and B in equal shares, or to A and B, whatever, then they may share in that DNI, but the point is that the DNI and the income first and then the DNI from that specifically gifted property is a separate share. And will only go to the one beneficiary, just to make it easy. So that if I give this building to beneficiary A, then all income attributable to this building goes to A. And the characterization is only to be rental income for that separate share. Notice, at the DNI level, you're treating the DNI separately. So it's the income and DNI from the building only goes to that beneficiary. Same thing with the rental expenses and the depreciation would only go to that beneficiary. Again, below the line, above the line with respect to the depreciation, but the only beneficiary it's going to ultimately possibly go to is going to be the one beneficiary who's entitled to a specific gift. It's not going to go to the residual beneficiaries. Even though they may be getting income, they're not getting income from this separate share. Okay? And let's see what else. So those are the big ones. And just remember the character also. The character will stay. So if I give the building, then there's going to be rental income. If I give stock, it's going to be dividend. If I give partnership, it's going to be K1. If I give a bank account, it's going to be interest. Or if I give a brokerage account, it may be a combination of tax-exempt income and dividend income. Okay, so again, separate share. Okay, we went through that last time, the application. Termination, page 54. So we need to know when an entity is terminated. Back in the day, 30 years ago, I can't even say 30 years ago now, 40 years ago, because 30 years ago was after the 86 Tax Act. 40 years ago, did you want to have a lot of trust returns or not a lot of trust returns? 40 years ago.
A lot of trust returns.
Why?
The income tax bracket is higher.
Okay, because back 40 years ago, a trust and an estate were each taxed just like an individual. And so if you have one individual, you get one run of the brackets. And you can only have one individual for one estate, you're only going to get one run of the bracket there. But I might be able to have 17 trusts. So I'd get 17 runs up the bracket. Okay, so back in the day, you wanted typically to have lots of entities. Okay, and that if you had a trust or estate, you wouldn't want it to terminate, you'd want it to continue on, because then if the trust, let's call it trust, it could be an estate, terminates and goes to 2 beneficiaries, you're going to get 2 runs up the brackets. But if you have the estate open and those 2 beneficiaries, you're going to have 3 runs up the brackets potentially, if you plan things well. The estate, or the trust, and the 2 individuals. And you may be able to max out here at the trust or estate level and move some down there, or maybe what you do is say, look, how much income do you guys have? And what I'll do is that I'll make just some distributions, so ultimately, rather than one person having 500,000 of income and somebody else having 100, everybody will have 300,000, or as equally as we can get it, so that everybody will, again, get the benefit of the low brackets to the same extent. Today, do we want a lot of estate, do we want a lot of entities or not? No, why?
Because the tax rate's more compressed.
Because the tax rate is more compressed. What's the savings at using all the lower brackets for a trust or estate? Anybody know what the savings is? You get to the highest bracket at under 13,000 of income. The savings, I believe, is about $800 or $900. Okay, that's using all the lower brackets for the estate or trust. It's just not worth it. Yes, $800 or $900 is $800 or $900, but it also is gonna cost you extra time and money to prepare a tax return. So some of that savings gets lost. Okay? So it used to be that the cases came up that people did not want the entity to be terminated. Today, they probably do want the entity to be terminated. And so what the rule is that the entity, either an estate or a trust, is determined to be open for the reasonable period of administration, and the administration cannot be unduly prolonged. The estate is considered terminated for income tax purposes after the expiration of a reasonable period for the performance of the exercise of duties of administration. When all assets have been distributed except for a reasonable amount which is set aside in good faith for the payment of unascertained or contingent liabilities and expenses. And that's on the top of page 55. That's language, by the way, that you will see in our documents, my documents that we draft. Yes?
What is an unreasonable amount?
You know, there's no hard and fast, rule, but we'll see some cases where some of these related issues have been litigated, but there's just not much authority. Just, pigs get fat, hogs get slaughtered. So just don't be too aggressive. But again, today you don't even want to. Today you want to terminate the thing so that you can get out of this. And again, you kind of have to look into see under the circumstances what's reasonable. If a trust says that it's supposed to terminate when somebody reaches the age of 30, but for extenuating circumstances, you'd think by the time they're 35, that trust wouldn't be administered anymore. And maybe if they're incapacitated or something, there may be some justification for not terminating it, but whatever. Section 642H deals with NOLs, capital losses or deductions, and termination of the entity. Those certain deductions pass out to the beneficiaries. Okay, and so you have to then know when you have a termination. Again, usually it's not much of an issue, but you can't have the NOL carry forward to the individual until the entity has actually terminated. And we talked before about how you actually burn off 2 years. Even though it's the same 2017, it's 1 year for the entity and another year for the beneficiary.
Is there any special way to present the carryover from, that gets picked up by the individual, when it gets transferred over to them?
Just a K1.
Just a K1, okay.
I mean, that's pretty much, that's the only receptacle for telling the beneficiary what he, she, or it receives. It's gonna be on the K1.
Like a footnote on the K1, or like?
I'll pull it up. Don't know off the top of my head.
I think there was a box.
There's a box,
Yeah.
okay.
Yeah, but we'll
The top right
Top
corner. I don't even know the number then.
we'll get it.
I think it's top right corner.
Of the 1041 K1?
Yeah.
Okay, well, I think it's 13, yeah, you're right.
12 is right below that, so if it's top right, it's like 11.
No. 13 is on top, unless if they're split in half, so the 1 through 12 and then 13 through 16.
12 is on the right side.
Hold on.
1041, Schedule K1.
Yeah, you're right, it's 11, 12, 13, and 14.
Booyah.
Booyah.
I don't know what they are, but I know the numbers.
Okay,
There's all
so,
instructions. That's right.
just a real quick, let's just do it in numerical order, a real quick run around the K1. Part 1, information about the estate or trust. So this is the payor, the entity, the name, the EIN, or EIN, the name, the fiduciary's name and address. If the final one, you check here, then you give the beneficiary's information, the ID number and name, address, domestic or foreign. That's in part 2. Part 3 is the various tax information that's gonna go out to the beneficiary. So what we have is, we have the interest income in box 1. And by the way, this is just your DNI, this is your categories, okay, of what we've determined based upon all those computations that we've done. So you've got your interest income, you've got your ordinary dividends and qualified dividends in line box 2, net short-term capital gain, net long-term capital gain. By the way, capital gain can be in the DNI, just remember, it can either be pursuant to the governing instrument, it can be because it's includable in the income, it can be the regular practice, or it can also be in certainly the year of termination. In the year of termination, the gains will get carried out to the beneficiary. The 28% rate gain in 4B, unrecaptured 1250 gain. Again, not every estate has all these stuff, or trust, that's all we do. Other portfolio and non-business income, ordinary business income, again, you're probably gonna have a what schedule. If you have number 6, what are you probably gonna have what schedule? Probably gonna have a Schedule C as part of your return, if you have ordinary business income. Net rental real estate income, other rental income, directly apportioned deductions, okay? Directly apportioned deductions, and again, there's also, just so you know, we're not looking at it, but there's an example, instructions, that's depreciation, depletion, and amortization. Okay, so those things, and that's why, by the way, in line 9, you have so much room, because you can put down an A, B, and a C, if necessary.
So that's where the allocated depreciation is recorded.
Correct. State tax deduction, we'll talk about that when we get to section 691C in several weeks, and that's number 10. Line 11 is your final year deductions. Again, certain deductions that will pass through, not all, but a few of them, like the capital losses and the NOLs. Okay, those are the 2 big ones that carry through. Line 12 is AMT adjustments. So not only do you have to do everything we've done to determine the TTI and DNI, but you also have to determine the AMT TTI and the AMT DNI to do everything for AMT purposes. In some cases, it'll be pretty easy, there won't be any adjustments. Other cases, there may be some adjustments. Credits and credit recaptures, other information. So let's see, 13. So just there's a list under 13 of all the credit and credit recap, maybe not all, but certainly a number of them. The orphan drug credit. I guess as you guys use that one all the time. Indian employment credit. All kinds of stuff. Biodiesel, renewable diesel fuels credit. Probably these things apply. And then 14 is the other information, tax exempt interest. So there is a line for reporting the tax exempt interest. Okay, that's the first one under 14. Foreign taxes, W-2 wages, net investment income. All these things you can see are things that the beneficiary needs to determine his or her income. And then other. Yeah.
Do credits get passed through on a terminated termination year?
Like what kind of credit?
I don't know, maybe research credit or whatever, where.
Let's see, wasn't one of them credits? Credits, that's 13. Yeah, it's all these. Credit for estimated taxes, that can be passed through to the beneficiary, backup withholding, so some of them do. Yes. Yeah, again, when you do your slice, when you get your DNI, the bottom line is that what you have in the fiduciary's hand is going to translate to the beneficiary's hand as to their share of the DNI that they get. Okay? Okay, planning for distributions. You need to have a distribution of some sort. Usually it's actually made, but we've seen how it can be properly paid or credited. Okay, and we saw the bookkeeping entries in pencil was not a good idea. But that they may be able to do certain things on the books where you don't actually have a distribution, but it gets carried out. Okay, so let's talk now about preliminary estate distributions. I have an estate where I'm the executor and we're kind of racing against the clock. We need to make a distribution by July 3rd. I don't think we're gonna get a court order to do it by then, to make the distribution by then. So I think what I'm just gonna do is I'm just gonna make the distribution and then tell the court what I've done and why, and ask the court to bless it after the fact, which is what we're gonna see in these next two cases. The Bohan, I think it's Buckmaster. Bohan and Buckmaster, yep. Okay, so hopefully you guys are still reading this stuff. What happened in the Bohan case? Read it? We're at the point of the year where hopefully somebody read it, yes, no?
Read it, but it's like hard to remember between, because there's always like so many court cases.
Okay. Well, again, this deals with a preliminary distribution. Okay, and so what that means is that you have an estate, and California says basically that you're not supposed to make any distributions absent a court order. Okay, again, there's a reason why I'm gonna do it in this case that I just told you about, because we need to get out the DNI, otherwise we're gonna have a bad result. And again, whether they were intending to do that here or not clear. But if you make a distribution before getting a court order, the question is that an amount properly paid or credited, such that it's treated as a distribution carrying out DNI. Remember, tier 1 is required income, tier 2 is other amounts properly paid, credited, or required to be distributed. And clearly, you don't have something here that's required to be distributed, but is it properly paid if it's distributed before getting a court order? And so here, the Bohan case, let's see, hold on, so we gotta get which one is which. So they made the preliminary distribution, and the government, the trial court held, this is on top of page 57, that the distributions were not properly paid and credited because they were subject to recall under Missouri law, meaning that if the executor had needed to get that money back to pay creditors, the executor would have had a right to get them back, so that Mrs. Bohan, who received these distributions, did not have an absolute right to get the funds. Again, they were subject to recall until the decree of final distribution. This holding that the distribution was conditional is obviously a correct interpretation of Missouri law, and the government does not challenge it on this appeal. Okay? And so the government still says that they were includable in her return because they were received under a claim of right. And basically the court says, but that's inapplicable here because you have a statute that says that it's subject to recall, which clearly means that her right to get the distribution is not superior to the estate's right, absent a court order. And so ultimately what the court says is that you do not get a distribution deduction for these amounts because they were made subject to the recall rights of the executor, not absolute distribution. Now let's look at the Buckmaster case. Buckmaster case, similar facts. Okay, the Bohan case, though, was 1957 facts. What happened in 1957? In the Buckmaster case, we're dealing with somebody dying in 1984, and it's sometime in the mid to late 80s. And so what happened here is you have Oklahoma law, similar to Missouri law. The distributions were made before obtaining a court order, but they were shown on the executor's final accounting, filed with a petition for final settlement, and ultimately the court approved them. By the way, in the Bohan case, do you think that the court ultimately approved the distribution to Mrs. Bohan? Yeah. Yeah. Ultimately, it was a proper distribution. The court's gonna bless the action that was ultimately taken. And so, in the Buckmaster case, basically, at the bottom of page 61, the last two paragraphs, they look at state court decisions in the Supreme Court, that what happens if you get an after-the-fact approval of an action. And basically, the court's approval validates that action. Okay? And so, you know, we have on page 62 and 63, kind of just looking at the big picture here, you'll see that, where did they cite it? Somewhere here, I believe, they cite Bosch. It's the, I don't see the citation of Bosch, but it's probably here somewhere. On the top of page 63, they're doing exactly what happened in Bosch, which is that if there is no clear authority in that jurisdiction, then the court making the decision puts itself in the place of the Supreme Court of that state and says, what would, in this case Oklahoma, what would the Oklahoma Supreme Court have decided here if it was presented with this case? And so our task is to determine how the Oklahoma Supreme Court, if presented with the issue before us, would rule. So I guess it's not citing Bosch, it's citing Adams and Arapahoe, but it's the same thing, okay? And so what they say in the final paragraph is, we hold the Oklahoma Supreme Court, if presented with the issue, would consider distribution of the state income by an executor made without prior court approval, but subsequently ratified by that court to be properly paid. Okay? And again, in 99.9% of the cases, the distributions will be ratified and approved. So you're ultimately gonna have that. And basically today, that's, I think, what you're gonna want. Okay, because that will give you the ability to get the money out of the entity, and it's predominantly the estate. Certainly trusts don't have that rule in California, but estates do. And so again, the good news is that if you need to get money out, you can. In my estate, I'm gonna make the distribution without a court order, I'm just gonna do it, and then we'll deal with it. And we're gonna get it blessed in short order. We're gonna use, because basically, we had a lot of expenses at the trust level, and we had an IRA payable to the estate with nothing to offset it. So if we just let things lie where they are, we're gonna have a lot of income at the estate level and wasted deductions at the trust level. What we figured to do is we're gonna use an April 30th fiscal year end so that we can get the estate deductions into the trust return for, we're gonna use the fiscal year for the trust, excuse me. And then we're gonna use that so that if I make the distribution from the estate to the trust, I guess how does that work? Maybe I don't even need to do that. Anyway, I have to think about that. Anyway, I've gotta get the income I've gotta get the income of the estate into the trust. And I have to think of my analysis, but basically, by doing that, we can use the income from the estate to offset some of the trust deductions that were paid in 2016. Again, not all of 2016, we're not gonna get the first 4 months, but everything after that, the deductions will be able to offset some of the income to overall reduce the tax burden. That's kind of the short, I don't know if you guys followed that or I was just rambling. But the point is that we're gonna try to have the deductions at this entity used and not wasted. There's no income at this level, at this entity, so we're gonna get estate income into it by virtue of a preliminary distribution. Just because we were tight on the time. Okay. So we've got 2 cases, Bohan and Buckmaster, pretty much opposites. Buckmaster is more recent. Buckmaster, I think, is more favorable. Probably, I think you can rely on Buckmaster. If you look at the annotations back on page 58, it says, even though Bohan, number 1, even though Bohan represents taxpayer victory, it seems wrongly decided. No presumed preliminary distribution can ever qualify as a distribution for income tax purposes where it's subject to recall, which is normally the case. Certainly California, Probate Code section 11620 is the same rule. Okay, but again, we have the Buckmaster case, which tends to make more sense. And the rest of the annotations on page 59 talk about kind of how you might want to do things, and it's California centric. There may just be not enough time to carry out the DNI, so you just do it, and then you get court blessing beforehand. The executor may consider making distributions without a court order in some cases. Again, I'm the executor in this estate, so I'm just gonna do it because I'm not concerned at all, and also the co-trustee of the trust. Okay. Before we get to trapping distributions, why don't we do another example? Okay. Did that one. Where is it? Okay. Okay, so you tell me if I need to write anything down, I'm going to read off these facts. Under the terms of a trust, which reports on a calendar year basis, $10,000 a year is required to be paid out of income to a designated charity.
Okay,
Right.
stop.
Right, that, the 10,000.
Okay. The balance of the income may, in the trustee's discretion, be accumulated or distributed to beneficiary A.
Write
Okay.
that down.
Write that down.
Discretion A. By the way, is this simple trust or complex trust?
Complex,
Why?
because it has discretion.
And the income is not required to be distributed.
Okay, there's two reasons. One, income is not required to be distributed, and
Charity.
there's a charitable beneficiary. Those two reasons it's not a simple trust. Let's see, expenses are allocable against income, and the trust instrument requires a reserve for depreciation.
Okay, so we have reserve depreciation.
Okay, so there will be a depreciation reserve. During the taxable year, the trustee contributes $10,000 to charity, and in his discretion distributes $15,000 of income to A. The
Write
tr-
it down.
The trust has the following items of income and expense for the taxable year. Dividends 10. Interest 10. Tax exempt income 10. Rents 20. Rental expense 2. Depreciation 3. And fees or commissions 5. Okay, so what's the first thing we need to do?
FAI.
FAI. How do you want to do this? You want to go around the room, or you want to?
What did you say that the depreciation reserve was? Did it say?
We told you the depreciation was 3.
But it doesn't say, it doesn't tell us the reserve?
Is
We're
that
going to
the same-
assume that that's both tax and
Okay.
reserve unless we're told otherwise. Again, in a problem, it would be clearer, but this is this problem. Okay, so we gotta determine our FAI. So anybody wanna,
Dividend 10,
dividend 10,
Interest 10.
interest 10, tax exempt 10, 20 for rent,
-2 for rental expense?
that's 2 for rental expense,
-3 for depreciation.
-3 for depreciation.
-5 for fees.
Why do you say -5 for fees?
Don't we have to allocate it to tax exempt?
It's 2.5.
It's 2 and 2 for what's called it, for
So-
it's 50/50, I'm sorry.
50/50.
Actually, if you paid attention, one of the things you didn't tell me to write down was expenses are allocable against income. So what is that telling us? 5. It all goes, there is no allocation. Okay, little things like that. So how much do we have on the plus side?
50,
15. How much do we have on the minus side?
10,
10. So our FAI is 40. So notice charity gets 10, and then what's left of the 30 FAI, A gets half. Okay. What's the next thing we need to do?
TTI.
TTI. Okay, dividends,
10,
10,
interest,
10,
10,
TEI,
0,
rent,
20,
rental expense,
minus 2,
depreciation.
3,
Is 3Y here?
you assume it's the same as the reserve.
Okay, and you have a reserve, so you take it above the line. And is there any excess depreciation?
No,
No, so there's no excess. So A isn't gonna get any, charity is not going to get any. Okay, and then fees,
they're all located.
how do we allocate them?
10 over,
And how do we, so we have, what are our tax exempt?
10.
10, and our total of these 3 items is, or these 4 items,
It's 50.
it's 50, so 10 over 50 is 1/5. So 1/5 is attributable to,
Non-taxable.
is attributable to TEI, so our fees that we can deduct are
4.
4, making our net year 9. Okay, so our TTI,
The charitable deduction?
we have a charitable deduction. Okay, good. So how do we do our charitable deduction, Nancy?
Oh, you allocate.
And we have to allocate again. So how much is going to charity?
It's gonna be 10's going, so 1/5 of that is allocated to TEI,
So what do we get to deduct then?
8.
So we have to 8 for charity, 642C, and by the way,
Reduce TTI.
everybody understand what I just did there?
Mm-hmm.
Okay, 1/5 of our 10 charitable. So what we have here is 10, 20, 40, minus 17 is 23. But we really don't need TTI, what we need is
DNI.
DNI. So we're gonna start with our 23, and what adjustments are we gonna make?
The additions first. So there's no capital gain, so. we
No
don't-
capital gain adjustment.
Mhm.
yeah, TEI.
What do we do?
It's
Do we add or subtract net TEI?
Add.
We add TEI.
Okay, add our net TEI, any other adjustments? Any extraordinary dividend? Oh, it's not a simple trust.
It's a
anyway.
simple trust.
Okay, any other adjustments? No?
Yeah.
So our DNI equals 30. Okay, now we have to determine the character. So we have dividend, interest, TEI, and rent. 10, 10, 10, and 20. We have rental expense, where should we take that?
Rental expense. Against rent.
Against rent. We have depreciation, where should we take that?
Against rent.
Okay, against rent. And then finally, we have